Hey everyone, welcome back to Corporate Decoder, the place where we try to understand what these massive corporate filings actually mean, and this one from Marqeta, well, it's certainly something. I mean, can you have too many share repurchases? We'll dive into that. Today we are diving into Marqeta's annual report. The headline, they actually made a profit for once. But digging deeper, there's more to the story than just that. Revenue is actually down and a key customer relationship is shifting. Let's break it all down. Marqeta runs payment card programs for other companies, so when people use those cards, that counts as processing volume. In 2024, it hit about $291 billion, a big jump from previous years showing pretty solid growth. Marqeta makes money by helping companies create their own payment card programs. They handle the tech side, letting their customers focus on building cool user experiences. They deal with debit, credit, and even those buy now pay later options you see everywhere. One of the biggest selling points of Marqeta is that their customers get a lot of control. Think custom spending limits, restrictions on where the cards can be used, all sorts of things. Marqeta also offers banking features, fraud tools, and a dashboard to manage everything. Marqeta has a few main areas of focus, like helping companies embed financial services right into their apps. This means letting businesses offer things like credit cards, loans, and faster wage access directly to their customers. Now, Marqeta's relationship with Block, the company that makes Cash App and Square, is really important. Block is a huge customer for Marqeta, representing a large slice of their revenue, although that slice is getting smaller. The contract with Block has been amended a few times. The latest deal extends the Cash App and Square debit card programs until mid-2028 and makes Marqeta the go-to provider for Block outside the US, so things seem stable at the moment. As part of their agreements, Block also has warrants, basically options to buy a bunch of Marqeta stock at a super low price. These options have vested, meaning Block can use them, but they haven't yet. Marqeta relies on banks, called issuing banks, and card networks like Visa and MasterCard to actually make their payment programs work. Sutton Bank is their biggest issuing bank partner by far, handling a large percentage of the payments flowing through Marqeta's system. Marqeta has partnerships with MasterCard and Visa that give them incentives based on how much volume they push through those networks. If those fees change, Marqeta's profit margins could take a hit. Marqeta faces competition from all sides, from old-school payment processors to new tech companies. To stay ahead, Marqeta needs to keep their platform cutting-edge, reliable, and easy to use. To protect their unique technology, Marqeta relies on patents, trademarks, and trade secrets, among other methods. They are basically trying to protect their technology and the brand. Being in the payments business means dealing with a ton of rules and regulations. Marqeta is under the watchful eye of agencies like the Consumer Financial Protection Bureau, and they have to comply with a bunch of laws around data privacy, anti-money laundering, and consumer protection. These rules are always changing, so Marqeta has to stay on their toes and be ready to adapt. The report mentions that the company's aggregate market value of Class A common stock held by non-affiliates was $2.5 billion as of the middle of last year. This is market capitalization and represents the price the overall market is willing to place on the company. The report also mentions the number of Class A and Class B shares outstanding. Now, every annual report has a section that lists risks. It's the company's legal obligation to make sure investors are aware of the company's potential pitfalls. Marqeta has been growing super fast, but that can be hard to manage. If they don't handle things well, it could hurt their business. To keep growing, Marqeta needs to get new customers and keep the ones they already have. They need to expand, offer more products, and build relationships with banks and card networks. Otherwise, their growth could slow down. A small number of customers generate a large chunk of Marqeta's revenue. Losing any of those big relationships, especially Block, would be a major blow. Marqeta has a history of losing money. They might not become profitable or stay that way. Marqeta depends on good relationships with issuing banks and card networks. If those relationships go sour, Marqeta could be in trouble. If Marqeta's new credit card platform doesn't work right, it could hurt their business. Also, a security breach could expose them to big liabilities and reputational damage. Finally, the company warns about market volatility and their dual-class stock structure, which gives more control to certain shareholders. They also talk about their share repurchase program not working out as planned, and this is a theme in general. Marqeta seems pretty aware of the cybersecurity risks they face. They have a Chief Information Security Officer, or CISO, and a whole team dedicated to keeping their systems safe. The CISO briefs the board regularly on potential threats and what they're doing to counter them, but of course there can be no guarantees. Now let's get to the numbers. Net revenue dropped pretty sharply for the year, mostly because of that deal with Block. They did manage a small profit for the year thanks to some one-time gains. Digging a little deeper though, you can see Marqeta's gross profit actually increased while keeping operating costs down. They are still sitting on a huge pile of cash, I mean over $1 billion. Overall, Marqeta is trying to build for the future. They are rolling out new credit products and finding other ways to move more money. We see this push in management's discussion in the report. One thing to watch is that there's a bill in Illinois that would regulate interchange fees. That could create some problems for Marqeta down the line, and it's something they mention as a risk. They are expanding into other parts of the world like Canada, and those expansions come with their own set of hurdles. Marqeta is in a pretty interesting spot. They've got a solid technology platform, and they are trying to diversify their customer base and offerings, which is a good sign. But they are still very reliant on Block, and that Block revenue is not what it once was, so growth is going to be difficult. We also see that they are facing challenges in maintaining its financial systems, and a good portion of their risk analysis is dedicated to their cybersecurity, so keep a close eye on that. They are also working in a super competitive market that is very subject to rapid technological changes, frequent introductions of new products and services, and evolving industry standards and regulatory requirements. Ultimately, Marqeta needs to prove they can continue to be profitable and that they can maintain their long-term relationships. It feels like they want investors to trust their ability to manage their share repurchase program, but they may need that working capital in the future as those things are hard to predict. Overall, a mixed bag, so let me know what you think in the comments below. Thanks for watching, and if you enjoyed the video, please like, subscribe, and hit that notification bell so you don't miss another corporate deep dive.